Thank you for joining us for today's webinar, Year-End Accounting and Disclosure Update. My name is Laurel Dobbin. I'll be your moderator today, and I just want to go over a couple of housekeeping items before our presenters get started. First off, for your webinar pane that you'll see on the slide in front of you, you can maximize or minimize the pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. So in the webinar pane, you'll see a chat box that you can use to enter your questions. Go ahead and type them in that box and then hit send. Our presenters will answer those questions as time allows at the end of their presentation. To ensure good audio quality, please check to make sure that your setting is correct. If you're using a telephone, please click on the telephone audio mode, or if you're listening through your computer, then please click on the mic and speakers option. Also, please note, as a participant today, you will receive a link to download the slide deck and recorded presentation within 72 hours. And now I'd like to just go over our how you qualify for California CE today. You must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and you also must complete the evaluation survey at the end of the webinar. And now I'd like to introduce you to today's presenters. First up, Matthew Peralt. Matt heads the SEC and Technology Audit Practice. He has supported more than 50 technology sector transactions. He's a CPA with over 20 years of experience, and he is a recognized subject matter expert and frequently consults in the areas of revenue recognition, business combinations, and equity accounting. And Katrina Starkova, she's a senior manager in audit. She works with both privately held and publicly traded companies in the technology sector. She also has a CPA with over 13 years of experience, and she has extensive experience in the areas of revenue recognition, equity accounting, and financial reporting. Today's learning objectives on the webinar: you'll analyze the impact of recently issued accounting standard updates on private and public companies, review the background, highlights, and application of recent ASUs, identify then when companies need to adopt and apply each of the new standards, and then discuss recent and ongoing FASB projects. And Matt, I'll hand it over to you for the overview presentation.
Thanks, Laurel. So this gives you an idea of some of the topics we're going to cover today. The intent of today's webinar was really to touch on any pronouncements which will be effective for this current year end, as well as taking a look at those that are in the pipeline that we expect would be effective in future periods. So just to give you an idea of what's coming down the pipe that may not necessarily apply to this year's reporting issues. So the first item we're going to cover is going concern. This is ASU 2014-15. And as you may recall, there was a proposal some time ago that would eliminated the auditor's requirement to opine on going concern. Unfortunately for our firm and all the other auditors out there, that proposal went by the wayside. And this proposal was really brought on board to, I think, address some of the issues with going concern. As you may be aware, any company that is not in an imminent liquidation basis is required to report as a going concern, which basically means you expect assets and liabilities are going to be used in a normal course of business. So you're not, labeling anything as though it's going through a fire sale or liquidation basis. But there was no explicit guidance about management's responsibility. Again, there was specific guidance for the auditors, and as a result there was some diversity in practice among what companies would disclose and just the depth of that disclosure. So that really was the reason for issuing this new standard. So the new standard highlights what is defined as substantial doubt, and anytime there is a condition of substantial doubt, it's basically taking a look 1 year out from the date the financial statements have been issued, or if the financial statements are substantively done, but maybe you're just waiting for the auditor to come in, then that is considered the date that they are available to be issued. So again, you want to make sure the financial statements are prepared as a going concern, because these disclosures wouldn't apply if you are in a liquidation basis. And there's a decision tree that you can walk through in the new accounting standard, and it basically takes you on one of three paths. Either you do the analysis and there is no doubt about the company's ability to continue for the next 12 months, in which case you don't need to make any disclosure. The second is a circumstance where there is substantial doubt about the company's ability to continue as a going concern, but then management comes up with a plan. That could be a restructuring plan, maybe sale of some of the company's assets, downsizing, some licensing of key franchises or patents. And then the third would be when substantial doubt exists and there isn't anything management can do to alleviate that concern. And so that would really define which of the three disclosure paths you're going down. And effectively what you want to do under this new standard, take a look at the required disclosures, but basically it's saying, what is it that is creating substantial doubt? And there is some instructive language in the interpretation here that basically says if there's recurring losses, you have negative cash flows, maybe you've lost a key customer, a license or a patent has expired, maybe you've had an uninsured loss. Those are the sort of things that you would want to disclose as creating a probable condition that the company is not going to be able to continue for at the end of the year. And then if you have the second category there, that your doubt has been alleviated by management plans, then you're going to want to go into some level of detail describing what are those management plans that you believe are going to mitigate the chances that the company goes out of business for the next year. So the standard doesn't really impact us, the auditor, but now you, management, are really going to be responsible for taking a harder look at whether or not you can go for 1 year from the issuance of the financial statements. And this standard, the effective date, I believe is, here we go on the slide, any annual periods beginning after December 15th, 2016. So for companies that are looking at this year, you don't need to be concerned about it, although early adoption is permitted, and certainly would recommend that you enhance your disclosures to just to respond to this ASU.
Okay, and it's time for our first polling question. Please remember, if you do want CE credit, you will need to answer 75% of these questions today. Who has primary responsibility for evaluating going concern? A, auditors, B, management, C, investors, D, auditors and management share equal responsibility, or E, not sure. I'll go ahead and leave the polls open for a little bit. Answers are coming in. And we'll give you a few more seconds. We'll go ahead and close the polls in 3, 2, 1.
And it looks like the majority of respondents chose management, which is absolutely correct. It's your company, so definitely evaluating going concern is your primary responsibility, although you can be certain that the auditors are going to be asking for if you're on the cusp of break-even profitability and recurring losses, the auditors are going to ask you to prepare a 1-year plan to demonstrate that, in fact, you have the ability to continue as a going concern.
Our next topic is on stock compensation, ASU 2014-12. This update applies to share-based awards with performance target that could be achieved after the requisite service period. So what does that mean? For example, an employee gets an award that vests upon IPO or profitability target. The employee is eligible to retire before the target is achieved and still be eligible for that award when it vests. Currently, there is no specific guidance on how to treat such awards. Some companies account for those as performance conditions that do not affect the grant date fair value. Other companies treat them as non-vesting conditions that do affect the grant date fair value. So this ASU removes diversity in practices, and it requires for such performance targets to be treated as performance conditions. So there are two main things to remember here. Performance targets should not be reflected in estimating the grant date fair value of the award. So when you measure the fair value of the award, you wouldn't apply any sort of discount to reflect the uncertainty of the performance target. And the compensation cost will be recognized in the period when it becomes probable that the target will be achieved. I would like to give you an example to illustrate this. Let's say the company grants stock options with 4-year service condition. The options will only vest upon IPO within 10 years of the grant date. Employees can terminate their employment after 4 years. So we have a requisite service period of 4 years, and we have a performance condition, IPO. The grant date fair value was determined to be $100,000, and it's not affected by the probability of IPO. IPO does not become probable until year 5. So in this situation, we won't record any cost in the first 4 years because the IPO didn't become probable until year 5. So the whole $100,000 will be recognized in year 5. But let's say IPO becomes probable at the beginning of year 3. So we're still within the requisite service period and we have 2 years left. So in this scenario, the cost will be recognized for the 2-year period, basically over years 3 and 4. So to summarize this, if the performance target becomes probable before the requisite service period ends, then the cost will be recognized over the remaining service period. And if the target becomes probable after the requisite service period, excuse me, the whole compensation cost will be recognized when it becomes probable. Alternatively, if IPO never becomes probable, then cost will never be recognized. The effective date for the standard is December 15, 2015 for both public and private companies. There will be 2 application methods. Prospective for all the awards granted or modified after the effective date, or retrospective for the awards that were outstanding as of the earliest period presented in the financial statements.
Okay, I'm pulling question number 2. Performance target should not be reflected in estimating the grant date fair value of award. Is this true, false, or you're not sure? We'll leave the polls open for a few more seconds. All right, polls closing in 3, 2, 1.
So most of you answered this question correctly. The correct answer is true. The performance target does not affect the grant date fair value of the award. Our next topic is on development stage entities. So this is great news for development stage companies. They will no longer have the special treatment. They will be treated just like everybody else because FASB removed ASC 915 development stage entities, which eliminates a lot of additional reporting requirements. It also brings US GAAP in line with IFRS because the concept of development stage enterprise does not exist in IFRS. The current guidance requires development stage companies to follow the same basic rules as established companies. In addition, they're required to present inception to date information in their income statement, statement of cash flows, and stockholders' equity. And since the new standard removes the definition and the concept of development stage entity, inception to date reporting goes away, and the companies will no longer need to show DSC labeling on the face of the financial statements, as well as include discussion in the notes. However, there will be disclosures needed in accordance with the risks and uncertainties guidance. So basically, the new standard moves guidance about the disclosures from topic 915 to topic 275. And lastly, the standard removes an exception provided to development stage companies in determining whether an entity qualifies as a variable interest entity. So the VIE analysis will be consistent for all entities. The removal of ASC 915 is effective for all entities on December 15, 2014. And the updated VIE guidance is effective 1 year later for public companies and 2 years later for private companies. Now Matt will talk about transfers and servicing.
Thanks, Katrina. So FASB ASC 860 speaks to transfer and servicing of assets. And that was really developed in light of the off-balance sheet scandals that occurred several years ago. And specifically in that guidance, there is a derecognition model which, when companies enter into repurchase transactions, let's say you've got a treasury bill and you are loaning out that treasury bill, or it's set to mature at a certain point in time a year from now, and you enter into an agreement, a repurchase agreement, whereby you will buy that security back, but the way the effective repurchase agreement works is such that the security matures on the date of repurchase. Under the existing guidance, that transaction was treated differently simply because your offsetting transaction was set to settle on the exact date that that security that you were loaning, or the security that you were using as collateral, was set to mature. And the FASB took a look at that and they said, well, it's not really any different except for the phenomenon of the date settling on the same date of the transaction. So why is there different accounting treatment for that? And so what this ASU did was change the accounting for those securities transactions that are labeled as repurchase to maturity and refinancing arrangements when they have the same maturity date. The companies most impacted by this would be banks and real estate investment trusts and similar entities that often enter into repurchase transactions. So what the standard does is effectively eliminate the ability to take off those assets on your balance sheet. And what it requires now is that it will look like any other secured borrowing. The asset that you have, the securities that you are typically loaning out until maturity, it really doesn't matter if you have transferred effective legal control of those assets. As long as you've retained effective economic control of those assets, and really what that means is that if the value of that security goes up or down between now and the maturity date, that you retain the risk and exposure to both the credit risk and the market risk that would happen during that period between the date of sale and the date of settlement. So basically the FASB concluded that in these circumstances it is the same economic equivalent of you holding that security, and therefore now under these arrangements you would keep those assets on your balance sheet, whereas typically before you were allowed to derecognize those assets and take them off your balance sheet. So now not only are these things now included on your balance sheet, but then you have to do some expanded disclosures to show the collateral nature of those securities, because now you've got them on your balance sheet, but the effective substance of that transaction is that when those securities mature, they're going to go to another third party. So the new disclosures effectively require you to look at anything on your balance sheet and make sure that you put in your footnotes a little table that's going to disclose any transfers that have been accounted for as a sale, and then any transfers that have been accounted for as a secured borrowing. And similar to the fair value footnotes for securities held, you're going to need to disaggregate those in two manners, really by the type of security, and then second by the maturity date of those securities. So it will, for the companies that do engage in a fair amount of repurchase transactions, it will result in significantly greater assets on your balance sheet and then substantially more footnote disclosure. Again, companies that you've seen that have those fair value disclosures around securities and have a fair number of securities, that's typically 1 or 2 pages. So you're talking about adding a substantial volume to the footnotes. And this is going to be effective for companies that have a reporting year-end for this year. And on an interim basis, obviously, going forward next year. Early application is prohibited. Yeah, it's prohibited, so the first time you'd be able to record it on an annual basis would be at the end of this year. And again, for public companies going forward, March 2015 is going to be the first quarter in which you will be required to show this on an interim basis. And for non-public companies, you can adopt it early as well. All right, now what I would see is the biggest change coming down the pipe, not effective for companies until a few years out, but I think this really is a project that's been under the works for a long, long time. And it was a collaboration between the IASB and the FASB. And really the reason that the FASB and the IASB sought to work together is just there was such disparity in the accounting guidance that was out there for revenue recognition. They recognized that there was some very complex and prescriptive rules around RevRec, and the simple volume of revenue recognition that was out there was just overwhelming, and companies spent a significant amount of time researching issues, and it resulted in really disparate treatment depending on a particular transaction or looking at one industry to the next. And so this, again, was developed over many years. I believe the proposal was originally birthed back in 2006, and now it's finally come to fruition. So the standard under U.S. GAAP and international financial reporting standards are effectively the same. The only real substantive difference is that the board used the term probable when talking about customer collectability issues, and under IFRS that's a much lower threshold than under U.S. GAAP, where probable is defined as greater than 50%. Some other differences: IASB versus FASB. FASB is going to require a little bit more interim disclosure. The IASB allows early adoption. And then FASB, consistent with the other pronouncements, is not going to allow you to reverse impairment losses that are taken, whereas the IASB does. So that's going to allow companies that are reporting on an international basis to recoup losses if, in fact, the entities subject to sale come back in value. And finally, the FASB is providing some relief for non-public entities around specific disclosure requirements. So what do you need to know? Widely speaking, the new standard is more principles-based than the current revenue guidance, and therefore it's going to require you to exercise more judgment. The good news is that there are more than 63 examples in the new standard that can walk you through, so hopefully one of those is going to be analogous to your business situation. But there are some complex issues that companies currently face, whether to report on a gross or net revenue basis. That's not going to really get any easier, that analysis, under the new standard. And also it's going to add some complexity. Companies that right now sell through an intermediary, an example would be a company selling through a distribution channel, may have elected a policy of sell through where they deferred all revenue until it was sold through that distributor. Now you are required to estimate the amount that the distributor is going to sell, and you can no longer defer the revenue. Additionally, entities are going to be required to capitalize incremental costs of obtaining a contract. So this guidance, again, most people would look at it and say, well, it's just revenue guidance, but there is specific guidance on cost that was added to this pronouncement for any areas that are not specifically discussed in other elements of revenue recognition. So one of the big changes in practice here is going to be sales commissions. Right now, we recently did a survey, and better than 70% of our SaaS-based customers, our clients, were expensing sales commissions. On a go-forward basis, when you adopt this new standard, you will be required to capitalize those commissions and then amortize them over the period of revenue stream. So companies anticipating adopting this policy or this new standard in future years are going to want to probably change that policy so they've got at least one thing out of the way on a go-forward basis. Some other substantive changes, just that bad debt. Now, under current reporting rules, you would record bad debt expense to SG&A. Under the new rule, you're going to be reducing revenue for that bad debt. And if you've got a customer who's got a long-term payment stream, then you need to impute interest. So that's going to reduce revenue, and then that interest component is going to flow through your interest expense on your P&L. And then there are, again, some more prescriptive rules around costs to fulfill your contract. Anything that, there was some wide areas of judgment in whether or not you capitalized or expensed those amounts. This new standard basically says if it's going to result in an asset, if it's directly related to a revenue contract and the costs are expected to be recovered, well, then you are required to capitalize that as an asset, as typically as a deferred cost, and treat that over, expense that over the life of the contract as opposed to expensing it immediately. Also, SaaS companies, be aware that any setup costs, you're going to need to definitely defer those and amortize them over the term of the subscription. But an interesting nuance here is if you had originally signed a customer up for a 2-year subscription and you were amortizing those costs over that 2 years, let's say in the end of year 1, the customer signs up and renews that subscription agreement for another 2-year term. Now you've got 3 years remaining, so you would take what was going to be amortized over the remaining 1 year and now amortize it over 3 years. So there are quite a few nuances written in this new rule that apply to both technology, retail companies, and there's some really good interpretive models out there. And I would encourage companies that are adopting, well, everybody's going to be adopting this new standard with the exception of companies that there are specific guidance points. And take a look at the following steps that you need to apply. Identify customer contracts. There's going to be a wider universe of people, entities that are identified as customers. Next step, identifying performance obligations. That for many companies is going to be entirely new. Performance obligation is different than the units of accounting because no longer are you going to have the roadblock of VSOE or fair value. Basically, the standard mandates that you ascribe some fair value to these performance obligations. The transaction price, one thing to be aware of is the transaction price is no longer necessarily going to be contract price. An example that they put forward in the standard is if a drug company is looking to break into a new market, they've got 1,000 units of a prescription drug, they're selling for $1 million, but they only expect to collect $400,000. They're recognizing they're breaking into a new market. Maybe there's going to be problems with insurance company reimbursement to the prescription provider. So in that example, although the contract price is going to be $1 million, ultimately the company's estimation is $400,000. So that is the amount of revenue that you would use as the basis for recognition. And finally, when you're determining the transaction price, you really have to take a look at, under the old revenue guidance, if your collectability was determined to be less than reasonably assured, you would simply defer all revenue. It was an easier answer. Now you are going to be required to estimate the likelihood that you would collect any revenue, apply it to each of those units of accounting, and the whole hierarchy that now exists between vendor-specific objective evidence, best estimate of sales price, all of that goes away, and really there's wider latitude in you choosing how you allocate performance, how you allocate the total consideration to each of those components of performance obligations. So really some wide-reaching changes that are going to happen as a result of the standard. I think the good news is that for software companies, I think revenue recognition is going to be a lot less punitive. You'll get a result that more accurately mirrors the economic substance of the transaction, but again, wider latitude. So on a go-forward basis, there's probably going to be some big adjustments when items are getting trued up, especially when you're making some significant judgments around the collectability of dollar amounts that are different than the contract amounts. So when is this effective, and how do you apply it? For public companies, it's going to be effective the period beginning after December 15, 2016, so 2017 for public companies, 2018 for private companies. And then there is some early application permitted. This sort of walks you through the methods of application, but I suspect most companies are not going to elect to early adopt just because of the complexity surrounding this. And then finally, how do you adopt it? There are two methods, basically the retrospective, where you are going to be required to restate those prior periods to show the impact. So for public companies that are adopting this and will be showing it in 2017, they're going to now need to start analyzing contracts that happened in 2015 and 2016 to make sure that they can restate revenue for all of those contracts. And the other alternative would be retrospective with a cumulative effect. Basically what that means is the opening balance sheet for 2017, you would just show a true up for the deferred revenue components and retained earnings that basically says here's all the contracts that were in force at the end of 2016 and how would those have been restated. So that gives you perhaps fewer contracts to analyze in terms of doing this retrospective application, but your investors may find it more useful to do a full retrospective application just so you know how those prior 3 years would have looked.
Okay, time for polling question number 3. Under the new revenue standards, you can expect which of the following? A, no change to current revenue rec practices. B, significant changes. Or C, you're not sure and you need more time to digest the new standard. We'll keep the polls open for a few more seconds. Closing in 3, 2, 1.
And it looks like the majority of respondents said they do expect significant changes, with the balance saying haven't had time to understand and digest the new standard. Yeah, I would say probably that's accurate, that 70% of companies out there are going to experience a significant change, and that they do need to modify their policies. An important thing for public companies here to consider as well is just what are the controls that you can put in place that will make sure those estimation and the estimation that you need to apply and the judgment that you need to apply is now under control. So, not just practically speaking, how do you do it, but how do you observe controls and test controls around those new judgments and estimates that you're going to need to apply.
Our next topic is on reporting discontinued operations, and it's ASU 2014-8. Currently, there are some inconsistencies in application of discontinued operation guidance. So this ASU, the objective of this ASU is to address those inconsistencies. It changes the definition and the criteria for reporting discontinued operations, and it also adds disclosure requirements. The ASU reduces differences between U.S. GAAP as IFRS because the part of the new definition is based on the elements of definition in IFRS 5. However, the two standards are still not fully converged. Under the new guidance, only disposals representing a strategic shift in operations should be presented as discontinued operations. Those strategic shifts should have a major effect on the company's operations and financial results. For example, disposal of a major geographic area or disposal of a major line of business. This change is expected to reduce the number of disposals qualifying for discontinued operations. However, I feel like there's still a lot of judgment involved in making that determination. So how will the disclosures and the presentation change? The presentation of the income statement won't change, but the presentation of the balance sheet will change. Currently, the assets and liabilities of discontinued operations are only shown separately in the current year if they meet the held for sale requirement as of the balance sheet date. Under the new guidance, all the prior periods presented will need to show assets and liabilities of discontinued operations separately on the balance sheet. As for the footnote disclosures, the disclosures for all periods will need to include the discussion on major assets and liabilities, as well as major line items of the statement of operations and cash flows. In terms of cash flow related disclosures, the companies will have two options. Option A will be to disclose total operating and investing cash flows from discontinued operations. And option B will be to disclose depreciation, amortization, capital expenditures, and significant operating and investing non-cash items. There will also need to be disclosure made if the disposal does not qualify for discontinued operations. So what are the effective dates for the standard? It's effective for years beginning after December 15, 2014. So for public companies, it will be effective in Q1 of 2015. And for private, for the private companies, for the year ended 12/31/15, if they have a calendar year end. And the companies can early adopt it. So the next two standards that we're going to talk about are simplified hedge accounting and goodwill accounting, are private company standards. And they're issued jointly by FASB and PCC. PCC stands for Private Company Council. These pronouncements provide exceptions and alternatives to private companies when dealing with these complex accounting issues. So we'll talk about simplified hedge accounting first. This ASU gives private companies the option to use a simplified hedge accounting when they enter into plain vanilla interest rate swaps. So what are the main differences from the current GAAP? The companies will have more time to complete hedge accounting. There will be no requirement to complete hedge accounting at the beginning of the hedge relationships. The companies will be allowed to use settlement value to measure the swap versus the fair value, which is currently required to be used. And the settlement value excludes non-performance risk factor. So that simplifies the calculation. This standard does not apply to financial institutions, nonprofits, employee benefit plans, and public companies. It will be effective for the annual periods beginning after December 15, 2014. And again, this only applies to private companies. Now, Matt will talk about goodwill accounting.
All right. So over the past several years, you've seen some significant changes in goodwill accounting and intangibles for both public and private companies, just electing to make these disclosures easier and more streamlined. So certainly this falls into that category. Why is there a change? Well, really, the FASB and the Private Company Council took a look at who was using the financial statements of private companies and how meaningful was goodwill in that calculation. And what they effectively concluded was the benefits do not outweigh the costs of trying to account for goodwill under the old method. And most users of private company financial statements are largely disregarding any goodwill in the calculation. So they came up with a simplified impairment model. And basically what it does is allows goodwill to be tested not on an annual basis, but only when a triggering event occurs. So the company can elect to just stream along and not do any impairment testing on an annual basis, and only if there are conditions or circumstances that lead them to believe the fair value has been impaired could they then be required to impair it. And another good change is that the qualitative assessment that you've done, only if that leads you to a more likely than not scenario do you then have to do the quantitative analysis. And under the quantitative analysis, your impairment step, you can eliminate step number 2, which would effectively allow you to reapply purchase accounting to the existing base of assets and come up with a rather complex calculation. It basically allows you to do the quantitative analysis right at step one, which basically just compares the fair value of the company or the reporting unit to the goodwill that's on the books. And so the standard really, I think, is meant to simplify, and the added benefit here for goodwill impairment testing is that the company can, once they adopt this standard, elect to amortize goodwill over the shorter of 10 years or any other period that they feel is appropriate. And so the likelihood of having an event that would lead to a goodwill impairment diminishes as you're amortizing that asset down. So most of our private companies have elected to early adopt this standard. Companies that were going through 2013 audits just said, hey, why not? It's an easier path for us to evaluate goodwill, and we'd like to start amortizing it to get it off the books, because for us it's rather meaningless. So early application is permitted, and for most private companies, I expect that's something that you are going to want to early adopt for this current period.
Okay, it's time for our fourth polling question. Please remember, if you are asking for CE credit today, you will need to answer 75% of these questions to get credit. As a private company, we will amortize goodwill. A, over 10 years, B, over 5 years, C, will not amortize, D, not sure, or E, not applicable. The votes are starting to come in. Give you a few more seconds to submit your answers. And we'll close the polls in 3, 2, 1.
So it looks like the majority of folks chose over 10 years, which is the sort of default answer issued by the ASU. So I think that makes sense to do it over 10 years, unless the acquisition that you've made that results in the goodwill clearly has a shorter life. So on to Katrina and income taxes.
Thanks, Matt. So this ASU 2013-11 applies to the companies that have unrecognized tax benefit and operating loss carryforwards or similar tax losses. There is some diversity in practice right now in how these are presented on the financial statements. Some companies present them as reduction to deferred tax assets, DTAs. Others show them as liabilities. The ASU states that an unrecognized tax benefit or its portion should be presented as a reduction to DTAs for net NOL carryforwards on the financial statements. There are some exceptions, though. Unrecognized tax benefits will be shown as liabilities if NOLs are not available under the certain tax jurisdiction to offset any additional taxes resulting from the disallowance of the tax position, or if the jurisdiction does not require entity to use, an entity does not intend to use the DTAs for such purpose. I'll give you an example to illustrate this. Let's say company ABC took a position on their tax return that reduced their tax by $100. The company determined that this position is less than 50% likely of being sustained if the company was audited by the IRS. So they have an unrecognized tax position of $100 that they need to record, or sometimes we refer to this as FIN 48 reserve. The company also has NOLs of $500 available to offset future taxes, and DTAs are expected to be realized. So in this case, $100 will be recorded against DTAs. So DTAs will be reduced by $100. So what are the effective dates? For public companies, this guidance is effective in the current year. So for the year ended December 31st, 2014, for calendar year companies. And for non-public companies, it's effective for years beginning after December 15, 2014.
All right, so now we'll jump into some of the FASB's proposed projects covering intangibles, income statement, and a variety of other things. So one of the first things was there is very prescriptive guidance around cloud service providers, and when you're providing such services, do you treat that as a license revenue or as services? Basically, you take a look at whether or not you have the contractual right, the customer has the contractual right to take possession of the software, and whether or not it's feasible for that customer to take the software and then run it on their own hardware or somebody else's hardware. The new guidance basically is not changing anything for vendors, the providers, but for customers. And really the reason this is important is because companies that are capitalizing significant amounts of software development costs for their products would need to know whether or not this thing should be expensed as incurred if it's a service contract or if it's to be treated as a license. So basically all it does is take the existing guidance as though you were the vendor, and now it applies it to you as the customer, and you use that as the basis for determining whether or not you treat it as a software license or a service contract. So pretty straightforward and simple amendment, and that is expected to be issued probably in 2015 with comments due in November of this month. Second proposal here is simplifying the income statement. Basically removing the concept of extraordinary items right now under GAAP. There's a list of extraordinary items that's pretty small. I haven't seen it too much in practice other than debt extinguishment costs. You know, if you've got something like an earthquake, hailstorm, sale of a land for a manufacturing business, something that really occurs both infrequently and is unusual in nature. Another example would be an employee benefit plan that has been terminated and results in additional cost or some benefit to the company. So basically all those items would be killed. There would be nothing any longer that would be labeled as extraordinary in the P&L, and any of those items then would necessarily move up into operating income. You still would be allowed to call them out on a separate line item. They just would lose that label of extraordinary, and you wouldn't apply the income taxes as you do right now when those are, you know, below the line. So I expect this proposal probably will come out in early 2015. But again, given that it's in the sort of deliberation phase at this point, you cannot early adopt this as it's currently written.
The proposed standard on inventory is intended to simplify the measurement of inventory. Current GAAP requires companies to measure inventory at the lower of cost or market right now. And the measurement for market normally involves determining the replacement cost of inventory. In addition, companies also need to consider net realizable value, the ceiling, and net realizable value less normal profit margin for the floor. So it involves a few steps. The proposed guidance will change the requirement from lower of cost or market to lower of cost or net realizable value. So it will simplify the measurement. The effective date is expected to be December 15, 2015, but the standard is not finalized yet. There is also a proposed standard on push-down accounting. It will provide the acquired entity an option to apply push-down accounting in its separate financial statements when the acquirer obtains control of the entity. the acquired entity would recognize goodwill in separate financial statements. However, it will not recognize a bargain purchase gain in its income statement. The guidance will apply to the separate financial statements of an acquired entity, both public and private. And for the subsequent measurement, the acquired entity would follow the business combination guidance in the current US GAAP. So again, this has not been released yet, so we don't know what the effective date will be.
The next piece of literature the FASB is looking at is basically financial accounting concept statements. Those were originally issued in 1978 and sort of got updated through 2000, but really haven't been updated since. The FASB is taking a holistic look at all of the information that is included in the footnotes and is seeking to eliminate disclosure about future-oriented information and considering the costs and consequences, and do they outweigh the benefits of disclosures that's happening right now in the financial statement footnotes. So the comments were due this past July. Many of the questions that the FASB was asking its constituents and users was, do these footnotes make any sense? Is the information meaningful? Is it useful? And I would expect that this is going to probably be a couple of years project, but it would eliminate a substantial amount of the disclosures that now seem to be really minutia and redundant. Oh, and then this is, I think, just a follow-on to what we talked about before, another proposal related to the intangible assets. Again, this is for private companies only. Right now, when you go out and get a valuation done in connection with an acquisition, typically some of the assets that are falling out are non-compete agreements and customer-related intangible assets that would be in the nature of a customer relationship where you expect future revenue streams from that customer. Now, this proposal effectively says both of those assets would not be separately recognized unless that customer-related intangible asset could be sold independent of the customer relationship. So, I expect this will be adopted shortly. The interesting thing here is that if you do elect to adopt these and not recognize those assets, then by default, they're going to get pushed into goodwill. And then if you elect to apply this new standard, then you're going to be required to adopt the new standard on goodwill, 2014-2, and therefore these assets will be amortized over that same period of goodwill because now they're a component of goodwill. So again, I think it just leads to further simplification around purchase accounting for private companies where, again, the constituents looking at the financial statements said it's really not meaningful, all these intangible assets that are sitting on the balance sheet for us.
Okay, well, I'd like to thank our presenters for sharing their insight and knowledge on this topic today. During the webinar, we analyzed the impact of recently issued accounting standard updates on private and public companies. We reviewed the background, highlights, and application of recent ASUs, identified when companies need to adopt and apply each of the new standards, and discussed recent and ongoing FASB projects. We did have a couple questions that came in during the webinar. I encourage those of you who might still have outstanding questions, you can go ahead and submit those at this time, and our presenters will go ahead and address a couple of those questions since we have a few minutes left.
So we have a question on the stock compensation standard. If you remember, costs should be recognized in the period when it becomes probable that the target will be achieved. So the question is on how you define probable. Is it more than 50%? I'd say probable is usually higher threshold than 50%. It's normally defined as 80% likelihood.
The other question we got was, could you repeat the new standard for revenue? Certainly not verbatim. The number for that is Accounting Standard 2014-09. Again, for public companies, that's going to be effective 2017. Private companies, 2018. And there are some very good industry-specific guidance interpretive literatures that have been published on those standards. So I would encourage you to read not just the general interpretation, but the wider or the more specific interpretation standards that are specific to your particular industry.
Okay, and we got another question here for you. How do you recognize revenue if the contract allows for continuation after set period on a month-to-month basis?
So, in that circumstance, if you do have any components of revenue that you expect, it's a performance obligation. So basically, first you got to divide the contract into the performance obligations. Now you've got your identified performance obligations. If a component of that obligation is going to benefit a future revenue stream, then you need to defer that and amortize it over the expected duration of the entire contract. So I would say if it's, if you've got a population of customers that are similar, that allows you to predict the lifespan and the usefulness of that asset that you're creating, then and the revenue that you're deferring, then you need to both defer that revenue over the expected renewal period, and then likewise you need to defer any costs related to that revenue stream over the full duration period. But I think in most circumstances, the performance obligations for that contract at the original signature are likely only going to benefit the first or two renewals, depending on the duration of those renewals. So again, it's going to require some significant judgment, but the good thing is there's no punitive result from exercising judgment. It's basically just a true up on a go-forward basis to the revenue. So if you've got one customer and you initially thought, geez, it's going to be a 7-year customer relationship, and then you've got 2 more customers that caused you to shorten that time horizon, you don't need to go back and restate revenue for that first customer that you thought was going to be 7 years. You basically just adjust things on a prospective basis for contracts that are still in force. So it will result in probably a need to track in-force contracts in greater depth than you may be doing now, because you may just set them up for revenue recognition and let them amortize as is. And so that's going to be a significant change. Got another question here. Will it be possible under the new revenue standard to recognize revenue and record a related bad debt expense in the same period? Absolutely. I think the standard, at its initial onset, you would, if you expect any amount of bad debt for that contract, you would record it. So your revenue would be reduced by the amount of that bad debt. And if you're still inside of that reporting period, let's say at the beginning of the year you anticipated a 3% uncollectability, and that was built into your revenue assumption, and then maybe you've gotten halfway through the year and now you say, geez, it's going to be 5%. That incremental 2%, you now are going to record that bad debt expense immediately. Well, I guess if in that circumstance, if you've got a contract that's still got 6 months in force and you're recognizing that ratably over the year, then that incremental expense you're going to recognize ratably over the remaining 6 months of the term. So it's really a continuous true-up and prospective treatment for the anticipation of any of these collectability issues.
Great. Well, thank you again to our presenters for fielding those questions. If you submitted a question that we didn't have time to answer during the webinar, we will follow up with you afterwards. Now on your screen, you will see the contact information for Matt and Katrina. So if you'd like to follow up with them after the webinar, please feel free to do so. They're happy to answer your questions. I'd like to thank all of you for joining us today and remind those of you who are looking for CE credit to please complete the brief survey at the end of this webinar. You will receive an email within the next 3 days with a copy of the slide deck and the recording as well, so you can review what we've covered here today, and also you can share with colleagues who might not have been able to join us. Thank you all for joining us today, and we hope to have you join us again soon on another Armanino webinar. Thank you.